gentlemen, Graeme Holm here, aka Australia's original money mentor, and it's an absolute pleasure as always each week to introduce you to the brilliant Dr. Andrew Wilson. I won't cover off his credentials. Most of you by now should know who he is and the amount of weight, his accreditations and his experience. He's definitely well versed as a talking head in the industry, and his knowledge, his degrees, his accreditation cover all of that. So let's not muck around. Well, good morning, everyone. And as always, the amazing Dr. Andrew Wilson, Chief Economist of My Housing Market. Good morning, Doc. And TikTok interest rates have gone up again.
Yes. Hello, Graeme. Good to be here again. And another, I guess, interest rate increase. Not guessing, it actually happened, but it's 10 in a row now, interest rate increases since May last year. Big question is it working?
The answer is no.
Well, no. I mean, the Reserve Bank governor's hanging his hat on a couple of, early signs perhaps that it is working. But you'd think from, going from 0 to 3.6% that you'd see some sort of energy, in terms of the plan. And the plan is to reduce energy and, but it's sort of some early signs, but nothing substantial yet. I actually thought there was a chance, given that the impact has been, modest at best of higher rates, that they would discontinue the sort of drip feed bit by bit, month by month. I thought they might have
just went whack with 0.5% and went, scare everyone to.
Yeah. I think, well, let's really get this show moving along. And, but no, it was just another 0.25%. And I think there's, some questions about, just the attitude of policymakers at the moment is just, we'll just whack it up another quarter and fingers crossed something will start to work.
Yeah, we're perceived to be doing something, I suppose.
But look, at the end of the day, nothing, has changed fundamentally to give us any sense that inflation is, heading, quickly in the right direction. And even, get rid of that word quickly, it's moving in the right direction, period. Because even though the inflation rate has eased, it's still, at the highest level since the 1990s. And it's really about improving the supply side issues, which were generated through COVID. They're sort of working themselves out at the moment, but now we're getting other issues such as, higher service prices and costs, which are working their way into inflation. And, it's still a very strong economy, Graeme. We can sort of point at some of the data, and the Reserve Bank governor in a speech that he's made just today as pointing to what he believes are, signs that the higher interest rate policy is working. The unemployment rate increased, retail sales, the trend was down a little bit. It's the GDP numbers were a little flatter, but they're December, so who cares? But as I said, he's hanging his hat on some factors which, I guess you could create an argument that things are moving in the right direction for the Reserve Bank. But then again, the absolutes are that it's very strong. The data is still very, very strong. And given 10 months of interest rate increases, how many more do we need before we start getting the sort of results that we're supposed to get according to the Reserve Bank's policies? And it's not working anywhere else really either. So, it's I guess the problem is that, it's a little bit like, well, we're going to go ahead no matter what. It's like, this is what the textbooks say. This is what our job is. Let's forget about, the sort of reality of the problems it may cause, and let's just continue regardless. And I just think up 2.5%. If they weren't convinced, and they shouldn't be convinced that this is having a reasonable effect on inflation, they should maybe go harder earlier.
I agree.
Not just drip feed every month. And I think part of that issue is perhaps consumers are just taking that into account now. And it's like, another interest rate increase, so what? It's just another 0.25%, and they get on with life.
Well, Doc, as everyone can hear, I've got a bit of a head cold today, so I'm going to be a little bit quieter than usual and hand over to you really to take us through the data. I might make some commentary towards the end if I'm not coughing and spluttering too much. So what we might do for this session this week, ladies and gentlemen, is Doc's just going to absolutely rip into the data, and I'll be a little bit quiet, not that I can help myself usually, but I'll be a little bit quieter than usual. And let Doc just take you through the data and give you some context to it this week and keep it short and sharp. So over to you, Doc.
Yeah, no problems, Graeme. I hope your cold gets better. It's we've had a lot of extreme heat down here in Sydney over the last few days, and it's not the time of the year to be getting a cold, is it? But
no, I just that last day after our event down there, it was 38 degrees, and I thought,
yeah.
Oof, feel like I'm back in Queensland, and then I come back to Queensland, it was raining and cold, so I think my body's in a bit of shock. But anyway,
yeah, we understand that.
But I'll go get a cup of concrete while you take us through the data, and I'll sit back, relax, and enjoy the show.
All good, Graeme. Well, look, it's been an interesting week in terms of the data coming out. Of course, we've just discussed another rate rise. Another small rate rise. Can we dare say ho-hum? Well, we should say ho-hum perhaps because we've had an interest rate increase every month since May. And, of course, the exception there was January when the Reserve Bank doesn't meet. And the rate cycle has certainly, moved into a very positive environment. 3.6% is the official RBA rate at the moment following that increase. We're still well below where we were at the peak of the previous tightening cycle, where the official rate was up at 4.75%. There's been a lot of chat, and even the Reserve Bank has indicated that it feels that it may peak out the current cycle below that rate of 4.75%. The market has expected that interest rates, the current cycle, would peak at around 4%, perhaps a little bit less. I'm not sure that's going to happen now. There are no real signs that the job's being done with these higher interest rates that we've had over the past year. But the Reserve Bank decided on another base rate rise, up 0.25%, and that is what I call the base rate because it's their preferred general measure, 0.25% up to 3.6%. 10 consecutive monthly rate rises, yet the economy is still strong, inflation is still high. Are higher rates working, and just how high will the Reserve Bank go? It certainly keeps reiterating that its policy, its aim is to control inflation, that it's prepared to do whatever it takes to control inflation, which is a little bit of a chilling, I guess, statement to make, given that with 10 interest rate increases, we've really yet to see a significant impact on economic activity as is supposed to happen. So it's that tunnel vision that the Reserve Bank seems to have in regard to, well, we're just going to keep raising rates until we start to see an impact. The problem the Reserve Bank has is that sometimes the impact is happening and it's not being reported until later. So by the time you do see significant impacts on the economy, it's already past in terms of the level where you want a soft landing, and it's starting to move into a more significant downturn. And that's what obviously the Reserve Bank is trying to avoid, is pushing up rates to the point where we do get a significant economic impact. But it's clearly continuing to state that, look, its job is to get rid of inflation, get it back to that 2 to 3% target range. That's underlying inflation. Underlying inflation is still tracking up towards 7% at the moment, so there's a long, long way to go. The forecast that the Reserve Bank has made over the past year in terms of where interest rates and inflation are heading continue to be revised. Certainly, I think the outlook now is for rates to not peak lower and earlier than expected, but given the forecast of the last 6 months, perhaps to now peak higher and later than expected. But it's a moving target at the moment, and I think the real issue is the uncertainty that's clearly pervasive within the Reserve Bank. It continues to say, well, we're just going to keep raising rates. We don't really know what's happening, when it's going to work, how high we have to go. But quite interestingly, the Reserve Bank governor made a statement just today that given that he now believes that interest rates are well and truly in the tightening or in the negative period, in the negative set, that we are closer to the point, and this is his quote, closer to the point where it will be appropriate to pause interest rate increases to allow more time to assess the state of the economy. So, there's some conflicts there in the statements that the Reserve Bank's going to hold its nerve and keep raising rates until it starts to see some results that it's looking for. But then again, it's saying also that it believes it's closer to the point where it may pause interest rate increases so it can assess the state of the economy. And I guess the question is, do they really know what they are doing? I mean, they know what they're doing in terms of, well, we're putting up rates until we can, quell inflation. But, in terms of other than just, well, let's just put it up another 0.25% next month, then it's really, in the lap of the gods to some degree. And the sense of uncertainty, and they're quite clear about this, is pervasive. But, Australia isn't alone here. US, the UK, Eurozone are all struggling with inflation. They're struggling to get it under control with higher rates. And the outlook really remains fluid in terms of interest rate policy. The other thing is that inflation, Australia now has a monthly inflation rate measure. There was, some concern that Australia almost alone was using a quarterly inflation rate measure. So it meant that we were looking, we only got our results every 3 months, rather than in the other major economies such as the US and the UK, they get monthly inflation data. But even the Reserve Bank, and there's been some improvement in that monthly data, but even the Reserve Bank has stated, the Reserve Bank governor stated that that new monthly data set is, can be unreliable, and it's experimental and volatile. So I wouldn't be, as they are, not reading too much into the results we're getting on that those monthly inflation rates data from the ABS. So that's the inflation story. We'll move on to some other data going forward. Really no news on inflation in the sense that other than we're going to see higher interest rates moving forward, but we don't seem to be, at this point, seeing any substantial signs, consolidated signs that it's starting to work. But in terms of the housing market, we had the latest home building data out for January. It showed home building is still falling. If we look at the total number of building approvals coming through for homes, we can see a big decline over January. Of course, we had a surge in building approvals in early 2021 as a result of the home builder policy. But since that worked its way through the system, and of course that policy ended, we're back to certainly a subdued number of building approvals coming through. And of course, this isn't good news for a market that's already undersupplied, as we know from the problems in the rental market at the moment. We'll have the latest February data on the national rental market shortly as well. But home building approvals still falling. And if we look at that over the month, houses down 13.5%. Units tend to be quite volatile on a month-to-month basis. There was a very big rise in December, but that's been now, I guess, normalised to some degree with a big fall. So a big fall in unit approvals over January, and the total down by 27.6% over the month. But when we look at the year-on-year data, that tells really the full story, with houses down 20.5%, units down 5.5%. And over the year ending January versus the same period the year before, total new dwelling approvals down by 15.2%. So if you're looking for relief from, particularly higher rents with more properties coming into the market, more new properties coming into the market, well, you can forget it, because we're continuing to fall away quite sharply. And this includes that coming off what was a significant period of house approvals through the home builder, in early 21. That's washed its way through the system. and we're now back to this chronic underbuilding environment that we have. And it's not just the planning restrictions that constrain development. It's also now, unfortunately, reflecting high building costs, which we'll look at in just a sec. So you can see there that the big picture is how we've underbuilt since 2016. Annual dwelling approvals on a monthly basis down by 29%, even including, that blip that we had in 2021. And it's units that really have led the charge downwards. We've underbuilt units significantly, and you can see how much lower unit approvals are, the trend for unit approvals are compared to back in 2015-16 at their peak. And despite that surge in house building approvals, as we've spoken about, we're now moving back to those pre-COVID levels in terms of house building approvals. And as I mentioned, unfortunately, and this is a driver of inflation, house building costs are still rising. This is the house building cost index from My Housing Market for January. Another increase. You can see how steeply house building costs have increased as a result of home builder, and really no signs that that's starting to ease significantly. And when we look at the year-on-year growth rates for house building costs, still up by 16.8% versus the same month last year. So, and down, of course, from the peak of 23.3%, but this is still a very problematic environment for builders, with house building costs and general home building costs rising steeply. And this gives another sense of, even with those building approvals, the question is how many of those building approvals will turn into commencements. I think we're going to see a much lower proportion of building approvals of commencements versus building approvals, whether they're postponed or cancelled, as a result of these high building costs, making some developments less profitable and maybe unprofitable, and therefore unlikely to go ahead. So that means even fewer homes coming through than what the building approval data is telling us. No surprise, of course, that home lending continues to fall in our correction period that we've gone through. Now, let's remember, this is the value of home lending. So it's not the actual numbers, it's the value of home lending. So, of course, that's exacerbated by falling house prices, particularly in the Sydney and Melbourne markets. So that makes that look a little worse than it is in terms of the numbers, because we're looking at the values. But also there's perhaps a tightening of credit from banks in this period of uncertainty, well, perceived uncertainty in housing market activity. So they're less likely to be perhaps as positive about lending policies as they are normally. But at the margin, we shouldn't be surprised of that home loans are falling, and we'll look to that to start to improve as the market renews its confidence, which we're seeing some clear signs of happening this year. Interesting though, even though home loans are falling, we're actually seeing refinancing as a proportion continuing to rise. There's a lot of refinancing going on out there as a proportion of owner-occupied total lending. And of course, that's the spectre of higher rates coming through is encouraging people to lock in rates, and also those that took out fixed rates 2 or 3 years ago. Those very low numbers are now getting in ahead, perhaps to try to get a better deal now before there are higher rates likely later in the year. So refinancing, although the absolute numbers have fallen away as total home loans fell away, the proportion of refinancing continues to rise. Well, we've mentioned the rental markets, and no good news here over February, the latest data. Sydney still remains the top performer in terms of the highest rents for houses and units. What we can see here quite clearly, which is sobering, is that the value of rents, this is weekly median rents, is closing in on the rents for houses in all the capitals. There's not a lot of gap between the two, except there for Adelaide. And certainly we're looking at the prospect of eventually perhaps seeing rental units, rents for units as high as house units, as house rents. And this isn't just about affordability, it's also and locational advantages that is driving more demand for units. It's also a growing interest in unit living as a lifestyle choice. But nonetheless, unit rents continue to rise faster than house rents. And as I said, the prospect is that we'll soon see unit rents as high as house rents in most of our capital cities. So February really is the beginning of the year for the rental market. January tends to be, is a holiday month, and we don't see a lot of moving going on during that period. But back up and running again through, even though actually Sydney house rents increased over January, which was, unusual, but again, reflecting how strong that Sydney market is in terms of demand being ahead of supply for rental properties. But Melbourne house rents up 3% over February, Adelaide up 2.9%, Sydney and Brisbane steady. But when we look at unit rents, this is some crazy numbers. Sydney unit rents up 3.5%. This is over the month. And Melbourne unit rents up 6.6% over the month. This is just, crazy stuff. It's very strong. Brisbane up 4.5%, Perth up 1%. And we've got to understand that unit rents, the reason we're getting these big increases, particularly in Sydney and Melbourne, is because they're coming off a very low base. We had high vacancy rates in Melbourne and Sydney units, particularly in the CBD market in Melbourne and the inner suburban market in Sydney. A lot of reasons for that. The closed borders, of course, shut away demand. We had Airbnb moving into the permanent market. And, of course, we had a lot of unit building happening in Sydney and Melbourne 5 or 6 years ago, which took some time to absorb. So Melbourne and Sydney unit rents are in catch-up mode still, but I think they're really now also about the search for value, particularly given high house rents. So very strong growth there. And I think we know, even from anecdotal evidence, just how sharply rents have risen for units in Melbourne and Sydney. Of course, in Brisbane, it's continued to rage ahead the Brisbane unit market in terms of rents. And a lot of that was driven, of course, by the surge in interstate migration through COVID, but continuing to rise here. Again, particularly Brisbane is focusing now on that preferred lifestyle choice that units are becoming, but another big increase in Brisbane rents over the month. And when we look at the annual increase, this is really bad news for tenants. We can see very strong growth. Again, Brisbane very strong over the past year, again reflecting that surge in interstate migration into Brisbane. And migration is still quite strong into southeast Queensland. So that's why we're continuing to see rents increasing. But all the capital city markets have recorded very strong growth in house rents over the year. And I think most data modelers are confirming, and the local state organisations, real estate organisations, are confirming this data. Amazing where we've got Sydney and Melbourne unit rents up by 30% over the past year. So in Sydney's case, it's gone from the 400s into the 600s, and in Melbourne's case, it's gone from the 300s into the 500s, and that's why we've got this 30% increase. But again, just reinforcing the fact that this is coming off a very low base in terms of what was an oversupplied market a year or for the past couple of years, a year or two ago, and that's why we're seeing these very strong increases continuing in Melbourne and Sydney rents, but they will consolidate as, of course, affordability barriers start to constrain the capacity of tenants to keep paying very high rents, or certainly high rents in terms of the rate of growth. And as I mentioned before, Brisbane continuing to produce very strong results for both houses and units. But really, this is across the board. We've run out of rental properties. Rents have gone through the roof over the past year for both houses and units. There's certainly no sign that this will ease. The only thing that will constrain rental growth will be incomes growth, but we certainly don't have any new dwellings coming into the market to offset this high demand. We have migration ramping up, so that's going to be more demand for rental properties. International students are also ramping up. Again, more demand, and it's just really a problem that's not going to go away anytime soon. And of course, this is all reinforced by those very low vacancy rates. Anything under 2.5% is really in favour of landlords. and even the vacancy rates for units in Sydney and Melbourne are now very, very tight. That Melbourne vacancy rate has plunged. So no wonder we've seen that spectacular increase in rents in Melbourne for units, given that vacancy rates were at record highs a year or so ago. So certainly that market is just about caught up with that period of oversupply. This is a QR code which you can take a picture of to get a copy of the full rental report with all the capitals for February. So you're all welcome to have a copy of that for our full rental market report. Just quickly, we also track here the Gold Coast, which of course is probably, we could count the Gold Coast as a capital city market, Graeme. Very strong market. It's been part of that Southeast Queensland energy. So just a quick update on what's happening on the Gold Coast. House prices are a little softer over the month on the Gold Coast and over the year. We know there's been spectacular growth, 20.4% over the past 2 years. With most Southeast Queensland markets, they've consolidated following what was unprecedented increases in house prices over the period. Again, we don't have the same level of migration coming in, fueling higher prices, but nonetheless, very strong growth over the past 2 years in Gold Coast houses. But when we look at the unit market, Graeme, this is quite exceptional. They continue to grow. There's no weakness emerging in the Gold Coast unit market. Gold Coast unit prices up by 1.6% over the month. Over the past year, up by 13%. And, quite spectacularly, Gold Coast units have increased by 32.6% over the past 2 years. So that's a very, very strong market, the Gold Coast. Gold Coast rents, even though house prices have eased, house rents continue to rise, 2.5% higher over the month, 15.5% higher over the year, and 40% increase in Gold Coast house rents over the past 2 years. Gee whiz, there's some big numbers there if you're a landlord, but pretty chilling there for tenants. But of course, this does reflect the surge in migration coming into the Gold Coast. And unit rents, even more spectacular, Graeme. Unit rents up by another 7.7% over the past month, up 17.6% over the past year, 42.1% increase in unit rents over the past 2 years for the Gold Coast, which
I'm pretty happy with that, Doc. Just quietly out loud, I'm very happy with that.
Yeah, quite amazing, really, Graeme. And, there's been some building coming through of new unit developments. That's eased recently, which isn't good news given these figures if we're, going to start getting a shortage of supply coming through. But no doubt demand remains well ahead of supply in the rental market on the Gold Coast. And this, of course, is very interesting news for investors and very good news for landlords looking to offset high inflation and higher interest rates, with these very strong results for rents on the Gold Coast. Now, we always finish off, Graeme, with our auction market update. Of course, last weekend was the first weekend of the autumn selling season, well, officially the first weekend. But we've certainly been able to get a pretty fair picture of what's happening in our housing markets over February and now into March. And no surprise that those markets have certainly performed very well, particularly Melbourne and Sydney. And most markets now, Graeme, are above 70% clearance rates, which is quite remarkable also. So we know that it's good to watch those weekend clearance rates. As you can see there, clearance rates track house prices in Sydney and clearance rates track house prices in Melbourne. So it's a good measure of what's happening broadly in our housing markets to look at those weekend auction clearance rates, which are very reliable and do give us a solid insight into what's happening generally in our capital city housing market. So these are the results for the first weekend of March, the first weekend of autumn. Numbers similar in Sydney to the previous weekend. Clearance rates down a little bit, but still similar again to the previous weekend, and a good result there. If you're getting 7 out of 10 properties sold under the hammer, it does show that sellers are starting to emerge with the upper hand. Similarly, Melbourne, although numbers were down sharply in Melbourne compared to the previous weekend, it was still another 70% result for the Melbourne market. You can see there that auction numbers are well below where they were last year at this time. And some analysts so-called analysts have been pointing at this as being a reason for higher prices and higher clearance rate is the lack of stock. Well, you've got to understand that a year ago, that these numbers we're getting now are much more what we call normalised numbers of properties coming into the market. A year ago, these were record numbers of properties coming into the market or properties for sale. And that's because of the backlog from lockdown in COVID. I think that's pretty simple to understand that, but it seems to be above the head of many. And of course, that dissipated as the COVID bank up of properties through lockdown was absorbed, and we're now back into more of a normalised market. But we're getting clearance rates, have a look at this, that are very similar to where we were a year ago in Melbourne and Sydney. But we were in a boom time, or coming at the end of a boom time period there. So that's a pretty good result given how strong the market was a year ago. Brisbane up over the weekend, up to 70% also, with lower listing numbers. Adelaide, the same, a number of listings, but clearance rates down. But Adelaide, Brisbane, Melbourne, Sydney, all above 70%. So that's a pretty fair, consistent result. But Canberra, again, the underperformer, just under 60%, but a big fall in auction numbers there. So just looking at the trends, Sydney market certainly started the year well, and it's tracking as high as it was, nearly as high as it was a year ago. Similarly, Melbourne is tracking at its highest point since April last year. Brisbane has picked up over February and into March, and same with Adelaide, although down a little bit on its very strong results to start the year. And the Canberra market's just sort of cruising along there, under 60%. But I expect the Canberra market to pick up as it does follow the Sydney market up and down, but certainly the Sydney market is in revival mode, as the latest prices data has shown, which increased over February for the first rise since in 10 months. So if you're looking for those auction clearance rate results, as usual, you can get them on my LinkedIn channel, Doc Andrew Wilson, available, the Capital City results available every Saturday night, and a full national report available on Sunday. So that's me, Graeme. Today, lots of news coming through. So back to you. And how's the cough going?
Man, not too bad. I stayed off air. There was a bit sniffly and sneezing fit. I thought I'll let you get through it all and try not to interrupt. But I couldn't help because, Doc, it was a couple of years ago in a break of COVID. We're doing a real estate event. And you said to me, gee, I tell you what, Graeme, I see some units with ocean views really seem to be moving on the Gold Coast when we were at that event that time for the breakfast. And I went, okay, silly me didn't buy one. I went and bought 14. But silly me with the 14, I'm now, as the
good on you, mate.
Over that 12-month period,
amazing. As
soon as I get that CGT discount, I'm selling them, and stuff I'm buying has gone up a couple of $100,000 left, right, and centre.
That's amazing, isn't it? And they're not making any more land, are they? And they won't be making another Gold Coast anytime soon as well.
That's for sure. So I definitely owe you a couple of beers for that conversation, Doc. That's for sure.
Good on you, mate. No problems at all. Being positive about real estate, I don't think, you should be, is rocket science in this country, because as we know, and we keep trying to point out, the historical trends are always positive. And we're seeing it again. And, despite interest rate increases, which we've had another one, we're certainly seeing, early signs, but nonetheless more than signs now that prices are back up again, particularly in the big Melbourne and Sydney markets. And, a lot of those that have predicted price crashes are now saying, it's just a pause. It'll resume its downward trend, soon. But, we've got so much demand and not enough supply, and this tinkering with interest rates doesn't seem to affect it confidence too much. And, the whole point
seems to be making a home or a unit more desirable before people believe it gets too far out of reach.
Yeah, I think there's a lot of, I don't think people are making their decisions based on what they're reading in the media anymore. And,
no.
Even the Reserve Bank, which confounds me to some degree, has been telling us that house prices have been falling in all its statements for, the last year. Now, even though Sydney and Melbourne house prices did fall following very strong prices growth, they were the only ones. So don't the other capital cities get a mention here? Don't they count? Have their prices continued to grow when the Reserve Bank was telling us generally that house prices were falling? I think one of the big mistakes the Reserve Bank has made had too much focus on the housing market I don't think it's got it right. In fact, I think it's got it wrong about the housing market. I'm not sure who does their analysis, but really they need to tighten it up a little bit because, again, we're starting to see a revival in our in house prices, particularly in Sydney, which of course led the market down. Now looks like it's going to lead the market back. Now, I don't know now the Reserve Bank will probably just stop commenting on the housing market, rather than
that'd be a good idea, I think.
I think it would be, and I think it'd be a good idea to forget about the housing market when you're talking about, monetary policy. I think they've made mistakes with monetary policy, in my opinion, based on misreading of the housing market. I think they've bought into the sort of boom and bust, scenario. In terms of the busts, we just don't see them in this country. And I'm not sure where they're getting their data from.
They should start focusing on the data, not their opinions, I think.
Well, ideology, it's this sort of thing, bubbles and, the reality is we just don't see that in this country.
Yeah.
And here we go again. We're starting to revive after what's been quite a modest, downturn, which was really the winter downturn last year, is what we expect. And really the trend's been positive for the last 6 months. And why should we be surprised when all of a sudden we have prices growing again? And I think the big thing that'll drive housing markets, Graeme, if our economy remains strong, and we hope that is the case, is that prices are still lower than where they were a year ago, Graeme.
Well,
so
I think,
you've got to be missing out.
We're going to be, before you know it, it'll be Easter in a couple of weeks' time, 4 or 5 weeks' time. And I think if we mark our words today and we come to Easter 2024, I think that homes will be worth a little bit more today, or somewhat more than they are today.
Well, I think by the end of the year, I think the Sydney market will be just about back to where it was at its previous peak. That means it's going to grow by about 7% this year, which is a good result. But I think, other markets will be above their previous peaks. It'll only really be the Sydney and Melbourne markets. But I'm still positive about Melbourne. I think it'll get back to where it was. But certainly it's a growing market at the moment. Yeah. There's rising confidence and prices are rising again. And as I said, in an undersupplied housing market, and Graeme, those rent numbers were horrific. They were just 6% increase in unit rents in Melbourne over the month. Just a very strong result. Well, I hope your coal picks up, mate. I hope it picks down. I'll
get another lem sip and a bit of concrete, and I'll harden up. So, but as always, Doc, it's a pleasure, and we look forward to seeing you next week.
Excellent, Graeme. More news then. Thanks, mate.
Thanks, Doc.